what is your current assessment of today's global economy and financial markets?
Well, with the benefit of hindsight, what we've seen over the past 20 plus years is markets in the economy do okay and do well when the central banks are easing and cost of capital is cheap and the liquidity is flowing, and then it reverses when they tighten monetary policy. And we're just sort of getting a rerun of the same movie, the same thing we've seen many times before. So essentially, this is just another sequel. And I don't think you needed to be much of a soothsayer to know that when you got inflation running at 40-year highs, that this time would be somewhat more pronounced in terms of its correction and reversal and response of central bankers. You know, for 20 plus years, inflation has been low, as we know, statistically speaking. That the government reports. But having that be the background allowed central bankers to do as they pleased on the easing side and on the tightening side. And having inflation run at the extent that it has sort of changed the tune. And while I do say this is a sequel with some more scarier characteristics, and that being inflation and the rapid pace at which central banks are now responding. So we have another example of the Fed and other central banks inflating asset prices to try to deal with an economic slowdown, whether it was COVID or it was in the mid-2000s or it was post-tech bubble burst. And now we are seeing the tightening because of the inflation story that we now are experiencing, but off a base of very high asset prices and an economic foundation that was built on cheap money, debt, and so on. So that is why we're seeing, I think, the rapid decline in equity prices and now a global talk of recession.
All right. So it really is, at the end of the day, all about monetary policy within the confines of what inflation is doing. So, you know, Fed easing, great, party on. Fed tightening, it's a lot less fun. I'm curious.
And sorry to interrupt, the reason why I say that is because this type of monetary behavior has created credit cycles where the economy ebbs and flows with the cost of capital. I mean, there used to be, before Greenspan, pool of savings that drove investment and drove economic growth. That's what you learn in school, is savings equal investment. And it's been reversed, where the movement of lower interest rates to encourage you to borrow, whether you're a household or a business, is what has driven economic behavior. So that's why I tie in the behavior of central banks and the cost of money so intertwined to asset prices and economic activity.
That's a great clarity. Would it be fair to say we moved from an era of natural business cycles to an era of sort of unnatural credit cycles?
That's exactly what we are in. And I started this by saying, we've seen this movie before, because that's what's happening, obviously in a more pronounced way and under different circumstances, but it's the easing of monetary policy that causes sort of the boom, the tightening of it that causes the bust.
To contrast with the business cycle, just like the seasons, right? You have sort of a boom bust to business cycles as well. The bust is to basically get rid of all the malinvestment, the bad companies that aren't sustainably profitable and whatnot, and then you start anew again, the new economic spring, and you're back off to the races. In a credit cycle, because you're monkeying around with the price of money, you create this artificial boom until you get to conditions that sort of force the system out of the central planner's hands a little bit, and then they basically have to step in, because they increasingly distort the system, and the more they distort it, the more the pain that the bust is going to be. So what happens is you get these increasingly larger and larger interventions to try to keep the system from right sizing, because the central planners have distorted it so much. And Peter, these are my words. They don't have to be your words. Feel free to correct me in anything that you're seeing here. But where I'm kind of going with this is you almost get this diminishing returns with these credit cycles, because it's almost like climbing a ladder. The higher you go, the more painful the fall could be at the end, if you just let gravity itself take over. And we found that more and more as the Fed eases, when it has its easing campaigns, the resulting economic growth we get from that isn't as much as we had in the previous up credit cycle. And so I guess what I'm trying to say is I'm making the argument that these credit cycles kind of have an expiration date on them at some point, because they can't go on forever. Do you agree with what I just said there?
You're basically defining the law of diminishing returns.
Yes.
And why over the past 40 years, each rate hiking cycle ended at a level below the previous peak of rate hiking cycles, because of the growing sensitivity that the economy has been dependent on to cheaper and cheaper money in order to sustain itself. Again, rather than using that pool of savings, we've relied on leverage. Because at the end of the day, just think about what monetary policy is. It doesn't grow the economic pie. All it does is just move around the pieces and alters the timing of economic activity.
Right.
So from a household perspective, it's telling a family, I know you want to save up 20% for that down payment, but if I lower your monthly payment through a lower mortgage rate, how about only saving up 10% and you can borrow less, but because I'm lowering mortgage rates, your monthly payment won't be that much different. And the same thing with an automobile. And then of course, with companies, they try to stimulate the capital markets, which then feeds capital into the private sector, and companies get financing and so on and so on. The problem with everything is on the business side, one of the faulty consequences is, while it helps the capital markets and those companies that have access to it, the small and medium-sized businesses that need to rely on that local bank, that local community bank for a loan, well, that bank doesn't have a capital markets business. They do business the old-fashioned way of taking in deposits and lending it out and collecting a spread. Well, in the old days, and I say the old days pre-Greenspan, that spread was maybe 300 basis points. But when you lower the cost of capital, when you lower the yield curve as much as you do and flatten it, that distorts the profitability of these small banks, and then it inhibits lending to small and medium-sized businesses. The point is that all monetary policy does is take forward behavior. So to your point, once you've taken forward so much behavior, you then have a hangover because there's no other behavior left to stimulate because you've already done it. And all you have to do is look at the Japanese experience, where they think that zero interest rates, negative interest rates is somehow stimulative. But it stopped being stimulative a long time ago. The regional banking system has been almost killed off in Japan. And when rates are low forever, you don't create any pool of savings of substance because people aren't encouraged to save. And you take away that sense of urgency. And that's why one of the other mistakes of central banks was this concept of forward guidance and their idea that it was stimulative. Them, by telling us we're going to keep rates low for a long period of time, thinking that that would somehow stimulate behavior. But it doesn't. It does the exact opposite. Like I said, it kills off banking margins. And from a urgency standpoint, well, I don't need to do something today because I can just wait till tomorrow because the cost of capital isn't changing anytime soon.
Right.
So therefore, it loses its luster, law of diminishing returns. It's no longer stimulative, and you can argue it's actually restrictive counterintuitively.
Right, right. Well, and the big reason for that, right, is the productivity hit. You're pulling future productivity into today, so it's stimulative in the immediate term, but then that debt is forever out there until it's paid off, right? And so as that debt builds over time, it becomes depressive, actually. So, all right. So, look, I think we're singing from the same song sheet here.
And one last thing to take it a step further is that the lower the Fed funds rate ends up being after that hiking cycle, the less tools they have to then stimulate at the next downturn.
Very good. Exactly. Yeah. They have less and less room to run every time they go through one of these cycles. So basically the main point here is These interventions are distortive. Some might call them perversive. They definitely end in what I think many people might say unfair distribution of how capital gets allocated. But most importantly, this thing has an expiration date, right? This is not a sustainable system. It gets to a point upon which it can't continue. And so the key thing I want to just drill home for everybody before we get into the specific questions here, Peter, is you said this has been going on since around the Greenspan time, so more or less 40 years or so, right? Which is, there are few people who are professionally active, who have been professionally active for longer than 40 years, right? So this system that we all know we may assume is going to be around forever because it's kind of all we know, like a fish is in water and just assumes the water is always going to be there. But it really is a system that can't sustain forever, and we may be getting near its terminus. We can debate how close to it we are, but it's not eternal, and we need to be aware of that so that we can not get caught by surprise when the end date arrives. Watch the full video this clip was taken from by clicking here.